Hi, good luck. I'm looking forward to it. Thank you.
So good morning, good afternoon, and good evening, everyone. And welcome to this third event of the 2022 fall season of the Accounting Design Project. Today, we'll have Sudipta Basu presenting the paper titled The Impact of Conservatism and Supply Chain Finance on Bad Debt Expense. I don't think Sudipta needs any introduction. We're all well aware of his extensive contribution to the accounting literature. So just a couple of rules about how the session will unfold. We'll give a few minutes uninterrupted to reach slide number 2 to Sudipta, and then you can ask your questions by either typing them in the chat or by raising your hand, and then either Sudipta or myself will just let you ask the question directly. So if there are no questions, without further ado, I would just leave the floor to Sudipta, and really looking forward to your presentation.
Thank you everyone for showing up. I hope we'll get more audience participants soon. This paper is co-authored with Yi Liang, who's on the call and is going to answer some of the questions on the chat. He was a colleague at Temple, but just moved to UVA. And Tom Canis and Mark Cecchini, who are colleagues of Scott Jackson, who sort of wrote the first paper in this area. I reached out to Scott. He said he's too busy. So he suggested his co-authors as people who would be useful to the project. Okay. So motivation. Connecting to Ray Ball's talk 2 weeks ago, Ray Ball asked, how should we evaluate accounting standards, right? What criteria should we use? Shyam has written on this. He published a book on this in 2016. And Ray said that we should be looking at, welfare. Do accounting standards increase welfare? Well, that's really hard to measure. And so we try a couple of ways of doing that. We look at, say, stock market reactions to standards. There's this paper that looks at all the FASB standards and finds an average small or negative effect. Or we could use things like proxies for accounting quality. So we might look at the quality of the accounting information, and that's sort of what the accrual models try to do, measure the quality using certain properties, right? So the standard accruals models here, Jones model, modified Jones model, and so on, they assume typically a linear relation between accruals and some proxy for change in economics, right? The specific one that's used most often is change in adjusted sales. That's the modified Jones model, but essentially any proxy for economic change. But I've always complained that these models essentially ignore everything that we teach in Accounting 101, right? So for example, in the chapter on bad debt expense, we teach two different methods, right? A percentage of receivables, percentage of sales. So take depreciation, we teach straight line and accelerated. If you had two identical companies that did exactly the same except for, say, depreciation, one did straight line, one did accelerated, they would both be classified as manipulating earnings because they're not at the mean. The mean is, somewhere between the accelerated and the straight line. And yet that is, they're not at the mean because they have to choose one of the two methods, and the two methods give you different numbers, right? So I think that if we're going to make progress on evaluating quality, then we need to sort of model the accounting. We can't just take a statistical model and pretend that that's the real thing. Related to last week's paper, Jeremiah Green looked at disaggregating the income statement and analyzing lines on the income statement, right? And looking at differences in volatility or other things on those different lines. Well, we're not going to take all the lines, we're just going to take one line, but the idea is that it's still related. If we sort of disaggregate and look at those lines individually, maybe we discover properties that are not being captured by the aggregate model. Instead, we try a bottom-up approach where we try to sort of model the accruals first and then aggregate up to the full thing. Okay. So the important thing that we think is missing is that, accounting is conservative in multiple ways. So Steve has some work on this as well, but using a different approach to conservatism. But I'm talking here about the approach in my dissertation, right? So that write-downs, but not write-ups. But this is not included in models, and so there's this big gap. And so then our evaluations of accounting quality that don't take into account the actual accounting are going to be leading to spurious conclusions. Last but not least, we're looking at a real transaction, a new real transaction, supply chain finance, that's taken off over the last 10 to 15 years, which, at the moment we don't teach in accounting, but the FASB has on its agenda a disclosure standard for specific to supply chain finance. So does the International Accounting Standards Board. So this is in the spirit of the accounting design project, it's sort of a new standard that is being worked out right now. And in principle, what we're going to be looking at can feed into it. I mean, not that I expect it, but in principle, it's related to thinking about how much will this new standard contribute and how will it contribute. Okay. So do the Jones models explain bad debt expense well? Do models that actually incorporate write-offs do better? When is modeling write-offs important? Is it all the time, or especially important during recessions? And does the supply chain finance affect bad debt expense? The floor is now open for questions. I've got past slide 2. Okay. So just to motivate us, here's a slide that sort of plots over time. Okay. The orange line is bad debt expense averaged across all firms each year. And so you can see that, say, in recessions, bad debt expense goes up, right? So in the early 90s, in the tech bubble period, 2001 crash, the great financial crisis in 2008, there are these spikes. The blue line is write-offs. And so you can see that write-offs tend to track bad debt expense pretty closely, right? That's not unexpected in the sense that bad debt is in some ways an estimate of future write-offs, the future uncollectibles. And so we expect them to be correlated. But the problem is that our models don't incorporate these write-offs. So if we exclude write-offs from our models and we just try to estimate, say, a pool regression using one of the standard methods, say the Jones model, the dotted line that you can see behind the blue and orange is sort of the expected bad debt using one of these models. Okay, and you can see that it is on average got the right amount, but the average is too low in periods of crisis like tech bubble and too high during boom times, right? So preceding the Great Recession. At the bottom, you see a gray line, which is the residual from these models. And what you see is that the residuals basically track write-offs very closely. Okay, so the blue line and the gray line are almost parallel throughout the graph, at least the first 20 years of the graph. They're moving virtually lockstep with each other. Okay, and so this is telling us that if we don't include write-offs in the model, we're excluding a lot of the information that is available to explain bad debt expense. In fact, we're excluding most of the information except the level. Okay. The second thing is that if you look at the right-hand side of the graph, so from, say, 2010 onwards, so the last couple of things, you see that the bad debt and write-offs are fluctuating, but the residual is not fluctuating as much. So it's much smoother. So that suggests to us that something's changed in bad debt around this period, because we get sort of similar fluctuations in bad debt expense and write-offs in the first 2 decades. But in this last decade, something seems to have changed. It's become much smoother, much less variation in this thing. And so we sort of wondered what could be going on. And so we started looking into what's changed in bad debts and receivables and stumbled across supply chain finance. So we didn't sort of go into this with a supply chain finance question in mind. We saw this in the data and then try to look for what could have changed that would explain this movement. Okay. And then it turns out that since then we've discovered, we started working a few years ago, but you know, now there's a lot of attention on this. Yep, Agnes.
Okay. I wonder if the trend could come from like there are many underwriters of the account receivable. So company just sell it to the banks or other investment companies, and then no need to recognize bad debt expense.
That's what essentially what supply chain financing or reverse factoring is. I mean, so we've always had factoring, we've always had securitization, or not always, but more recently. So if you go back to the early 2000s and stuff, right? So we've had securitization of receivables and for some time, and factoring even longer. So even when I was in grad school, or undergrad, there was factoring, right? But supply chain financing, and I'll explain this a little bit more later on, is when the buyer initiates the factoring as opposed to the seller. So the supplier has a receivable. In traditional factoring or securitization, the seller then goes out and sells the receivable. Here, the buyer is leveraging its credit rating to get better terms for the suppliers. And so that's why it's called reverse factoring.
Sorry, I didn't get a chance to read your paper, but I might see the supply chain, and I thought customers or suppliers, they can finance for each other.
Mm-hmm.
So, so that part, you know, like because of the supplier and customer, they seems get tighter, you know, relationally recognized more important, you know, especially so-called the climate change and whatever happened to the supply will happen to customers. So they get tighter, you know, working together. So I thought that's what you are examining. But now leading to, do you have to control that, you know, how the supply customer, they work together?
Well, in some sense, they're separating because you're introducing the bank as an intermediary between them. So once you sort of supply the goods, the supplier is not waiting for the customer to pay. The supplier is going to the bank, or the buyer is going to the bank, and the bank is paying on behalf of the buyer to the supplier. So at that point, the sort of relationship is complete, right? So in the sense that the suppliers deliver the goods and receive their money. The buyer still has something to do with the bank. The buyer still has to pay the bank. And so the risk has been shifted from the supplier to the bank. So in some sense, there's a loosening of the relationship.
I'm just thinking, no, you know, maybe I didn't get my question more clear. I'm just saying that thinking about supply and customer, supplier will select the customer. And then, you know, we get closer. For example, if I'm the customer and then supply select me because suppliers knowing that I will not really, you know, not being able to pay back what I buy things from. I'm just saying this kind of tighter relationship without the banking's help, just the supply and customers close relationship may also explain the decrease of the bad debt expense.
So maybe we should talk about this offline, because I mean, suppliers and buyers have always had a close relationship. So I can't see why anything has changed now as opposed to earlier. But maybe we can talk about the sort of details of what you have in mind later. Right? Ayung.
Yeah, so Sudipta, like I think when I look at this graph, your figure 2 and then the results, something kind of like very surprised to me is if you look at after 2005, the contemporaneous bad debt expense and the write-off is almost kind of co-moved together. Mm-hmm. And that is something kind of like very different from what I thought about the allowance approach. Right? Allowance approach is that's when accountants try to come up with an estimate ahead of the write-off occurrence, and then try to estimate to match expenses with revenue, and later on write-off will actually happen potentially in the future period. So like if you look at the graph, the earlier period, you can see the blue line usually is kind of lacking, right? But the later period, it seems that this orange and blue line just overlap with each other, and it's kind of quite, the co-movement is quite significant statistically based on your model. So is there any explanation for why those two actually kind of like just co-move with each other? It's because more firms actually their incurred loss model will become more like a derived write-off model, or it's actually operating cycle is short-term, or it's because the underlying economic states is very stable, so your estimate essentially just the same as the realized outcome from the previous state's estimate. It's their model. I just want to hear your thoughts on the
So
increase.
you're right that, officially we were on an incurred credit loss model and still are until recently, right? Until CECL. But until the 1990s, firms actually used an expected loss model, even though the standard required an incurred loss model. Okay, so until 1998 or 1999, firms actually used an expected loss model. Then the SEC stepped in and said, you can't use an incurred expected loss model. You must use the incurred loss model because that's the standard. So at that point, the banks were forced to switch to the incurred loss model, which then, doesn't produce that.
Yeah.
Right.
So you would say the incurred loss model exposed when we look at a graph will be kind of similar to the derived write-off model, right? Because they have to wait for, so even it's a cool model conceptually, imposing that constraint actually the outcome.
So
in terms of the timing of
insisting
recognition.
on not using an accrual model, if you think about it that way, they're sort of insisting on, of course, now the new standard with CECL is going back to the expected loss model. But right in the late 90s and early 2000s, Levitt, earnings management, cookie jar reserves, all of that stuff, they were worried about too much reserves that could be then later released to manipulate earnings. So this was a way of getting rid of cookie jar reserves by saying you can't put on expected losses that haven't yet occurred.
I see.
And so then use that to manage earnings. So this was the reason, both in banking and in bad debts, that we see a difference in patterns.
Thank you.
Sanjay?
Yes, thank you. I'm looking at this graph and then I'm thinking to myself, when do we want these models to work especially? Right? I think we want it especially when we see these peaks where economic problems seems to cluster. And of course, we ask two questions. One, is it something firm specific where they're not doing what they're supposed to do? And two, should the accounting give more of a signal? And so, especially when it comes to bad debt expense, to what extent do we want to model this? So for instance, do we want some fixed effects for these periods in that, because you already have the firm fixed effects? The question with the firm fixed effect is, do we take out what we want to take out, which is some firms might select into not reporting what they should report? And do we want this model to work more in certain periods? Of course, there is some hindsight bias here, but I get, if I look at the expected value, especially in those peaks, is when we have the problems. So these are my two questions that I have based on this fiction. Thank you.
So if you were to take the FASB approach, you want fair value for everything. I mean, I'm caricaturing the FASB a little bit, but you want fair value for everything, in which case everything should move with market values, right? And so then you should get big troughs during a recession appropriately because market values of your receivables have fallen. And so that's essentially what bad debt expense with the sort of positive sign, it's a negative, is doing. It is following the values. But the question is whether we should be symmetric or not symmetric. That's a big question, right? So are investors loss averse, or are they, care about statistical risk? So Shyam has, discussed statistical risk, which is two-tailed, and hazard risk, which is one-tailed, right? And Steve also works on this sort of question of how do we account for uncertainty? What kind of uncertainty should we care about? And essentially, we all agree that we should care a lot more about one-tailed risk than our models or the regulators do, because that's essentially what you insure against your house losing value. You don't insure against your house increasing value. So, we have, we can show that, it's easy to show that bad debt expense and write-offs climb in recessions. And the question is, how much of accounting is forward-looking in an accrual sense, and how much of it is backward-looking in a deferral sense? My sense is that balance sheet is mainly deferrals, not accruals. And I think most people sort of looking at the FASB conceptual framework are misled into thinking it's accrual accounting when it's really deferral accounting. Shyam?
Okay, thank you. And just a question: should we correct for that with our structure, or not? And that was just the second part. But maybe we can also discuss it another time.
Yeah, I mean, we can. I mean, we could put in your fixed effects, but that's driving out sort of the the variation over time. And I don't know if I want to do that. I want to sort of see when the model works well and when it doesn't, or how the different models work across time in capturing that. Shyam?
I just have a brief question, Sudipta. Thank you. I would have thought that over a long period, like 30 years, the average of the bad debt expense and write-offs will be about equal. And it doesn't seem to be the case from looking at the red and blue lines. Where could that, especially in the first half of the line, could that be in the first such a long period of time, about 15 plus years? The write-offs were always less than the bad debt expense. They never caught up.
So that's why the SEC intervened, right? So this is why the SEC, because firms are using an expected loss model, they were reporting more bad debt expense than actual write-offs. So that's part of the Canis and Jackson and Liu paper in 2010.
But the excess bad debt expense in 1 year will lead to reduction in bad debt expense in a subsequent year, right?
If the write-offs
to keep the balance in the balance sheet account close to zero. Or steady. Anyway,
yeah, whatever the percentage, but the thing is that it was growing, and that's why the SEC stepped in, because it felt that this was part of the cookie jar reserves. And so
okay. Sorry, I should learn how to raise hand. I'm sorry. Can I ask a question?
Sure.
So I try to find out how do you really generate the residual, and do you use like firm specific analysis like Jones did, or do you industry by industry year? I couldn't quite find. Pardon me?
Just a pool regression.
And we know that those kind of a regression model matter. And from your chart, because there's actually surprise intercept when Jones, apply the model. And I always like that model because of if you run the regression by industry, the residual error will be zero.
We run firm fixed effects.
But yeah.
So
yes,
that's
but
better
fixed
than
effect, yes. But fixed effect cannot control for the differences, different coefficient for each firm. Because each firm has an expected relationship between account receivable and the bad debt. And so if you do not use the firm-specific regression or control, that variation will not be able to, be captured. So,
being averaged, yes.
Yeah, so I always feel like because of the coefficient you capture, the coefficient, not the fixed effect. The fixed effect only look at the differences of the write-offs across firms, but the coefficient is different across firms. So when you have the residual errors, that the mistake a lot of could be due to the fixed coefficient we applied in our pooled amount. So that's my comment and question. I wanted to use the firm-specific model.
We can,
does it help? Does it cannot?
it doesn't help much, no.
Yeah.
Because, I mean, using the firms, I mean, already the fixed effects is pulling out the averages, right? So it's all the firm averages are zero.
Coefficient, not the, but not the difference coefficient.
I understand the coefficient, but the residuals are still mean zero. And we're plotting the mean residuals, right? So now you can shrink that amount of residual variation a little bit because we're estimating the average residual anyway across firms. We can get more precise estimates, but I don't think it's going to change the pattern that much. And anyway, when we get to the regressions, you're going to see that we're using firm fixed effects. So you can ask the question again at that point.
I noticed you use firm effect, but it's still, as I say, the coefficient may vary. But anyway, go on.
So
Stephen, are you asking a question?
We have a couple of extra questions in the chat. So the first one is John.
Jonathan.
Oh, it wasn't really a question, just a quick comment that, I don't, do we have a good understanding to begin with of why in the past, lower credit quality suppliers provided finance to higher credit quality buyers, right? It seems like supply chain finance has sort of, gotten rid of that issue, but you wonder why that arrangement existed in the first place. Was it, as Agnes said, maybe some part of their old relationship and now something new has stepped in. They have other aspects of their relationship. Do you have a sense of why that financing existed in the first place?
I don't, but I assume it's something to do with bargaining power, right? I mean, if Walmart wants to buy from you, you're a small company, you're going to sell to Walmart because it's advantageous. I mean, your
I know, but the supplier has to go borrow from the bank at a higher interest rate, right? So why don't they do it more efficiently by having Walmart do the borrowing and extract it via the price directly rather than through the credit arrangement?
I think, so first they did securitizations and then now the reverse factoring where they're exploiting the bank, but I don't know why they didn't work out a solution earlier. Yes, I agree that. I don't know what the friction was earlier. Let me put it that prevented it from happening. And then there's a growth something, right?
Yeah, expectation about future growth. Do you want to ask the question, Ayang?
It's not a question. It's about kind of like related to Shyam's earlier point about why 30 years is not converging. I think Sudipta already answered that. In the 90s will be the expectation about future growth. That's why expected loss model would always kind of like overbook. Yeah.
So the main findings are that the relation is not linear, but V-shaped. Models that incorporate conservative adjustments either through a piecewise linear model or write-offs have much higher explanatory power than the Jones model, modified Jones model, or even a balance sheet model. These models perform especially well during recessions when write-offs are usually higher. And so because the distribution is skewed, to go back to a question that Sanjay was asking, even if you sort of put in those things, you would still capture variation in those different periods because there's tails, which really become prominent during recessions. The additional explanatory power stems from the unexpected rather than expected component. So you could see that in the sort of heavy gray line and the dotted gray line. The dotted gray line doesn't do much. And then when we look at that period after 2008, when SCFS takes off, there's less variation in the bad debt expense. And that's sort of consistent with the suppliers getting cash earlier and therefore not booking as much receivables and not needing to book bad debt expense. So Ayung reviewed her financial accounting textbook for this session. So just a quick review of the journal entries. When you sell on credit, you debit receivables, credit revenue. And then if you're following the percentage of sales method, following the matching principle, you would accrue bad debt expense as a percentage of sales and book the credit to the allowance for doubtful accounts or bad debt. Then as debtor's default, you adjust the allowance and you write up the receivables and you match that against the allowance you've set up. And So lots of people take away from this that write-offs don't affect the income statement, they only affect the balance sheet, because the write-off entry does not involve the income statement at all. It's an entry between two real accounts, or two balance sheet accounts. And so there's sort of a common wisdom that write-offs don't affect the income statement. The point, though, is that the end of period adjustment actually brings in the write-offs, because you have to set up the allowance to be a percentage of the receivables on your books at the end, and you have to adjust for whatever it takes to bring it up. So if you have a lot of bad debt or write-offs during the period, you have to set aside extra allowance to cover those write-offs. Okay, so two firms, same beginning receivables, same ending receivables. Okay, one firm had no write-offs, the other firm had a lot of write-offs. The firm with a lot of write-offs has to do a lot of bad debt expense in this adjusting entry to get to that same ending balance. Okay? So even though the write-offs don't affect the income statement in the third entry, they essentially go in one for one in that fourth entry into the bad debt expense. Okay? And I think this is sort of what is missing in some of our models. So the income statement is affected by the bad debt expense there, but the balance sheet is really affected. Both of them are affected in this fourth entry. Okay, so just continuing on this, reviewing the methods. When we use the balance sheet approach, aging receivables, we take allowance as a percentage of the receivables, right? Adjusted for ages. When there's no write-offs, then the bad debt expense is just allowance times the change in the receivables, again, appropriately aged. And the empirical model would then be bad debt expense as a percentage of this change in receivables. Okay. If a receivable is uncollectible, it should be written off. And so in the US GAAP, receivables can be written down, but you can't write up unless you actually collect cash. So you can't just reflect the increased probability. You have to actually collect cash to add them back into the book. So write-offs decrease allowance and later increase that bad debt expense through that adjusting entry. And that's, I think, the important part here. So the true model is closer to bad debt expense allowance. Bad debt expense equals the change in allowance plus the write-offs during the period. Okay. And so then our empirical model, better empirical model will have both change in receivables and write-offs as explanatory variables. Under the income statement approach, bad debt is a percentage of sales. So you're just going to regress bad debt on sales for the period. So we teach both of them. Why do we teach both the income statement and the balance sheet? Well, during the period, it's easier to estimate the percentage of sales method because you're constantly selling, so on credit, so you know how much to expect on average from each sale. Sort of like our inventory accounting, we sort of come up with estimates of our direct materials and direct labor, and then at the end of the period, we do an adjustment. So it's useful for planning and budgeting, and it's useful for forecasting. So if you think financial statement analysis textbooks, they typically start with forecasting sales and then forecasting all expenses as a percentage of sales. Okay? And similarly, inside companies, this might be a useful thing to do. But then at the end of the quarter or the end of the period, firms switch to the balance sheet approach. And that's because GAAP requires essentially that you have an adequate allowance for the bad debts. And so this arguably comes from creditors wanting an estimate of net realizable value at liquidation. But then auditors also are required to test that adequacy. So,
Yeah.
Yeah, so related to kind of like your earlier answer to me about in the 90s, firms tried to kind of build up this cookie jar. It made me think about that in the model, should we consider how much the firms already put into the allowance. Because if they book a lot of allowance before this period T, potentially bad debt expense doesn't need to actually increase that much. Like the model you have now, you have AR changes right off this period, but it doesn't seem that there's anything capturing how much the firm has accrued to the allowance account.
Yeah, so long as the allowance is sort of proportional to the receivables across time, so each firm, like Agnes says, has its own coefficient, but so long as they're consistent, then the change in receivables will capture that, right? So if they're setting aside, say, 2% consistently over time, then the change in receivables capture that. Only if there's a disconnect that they're changing the percentages, this won't work.
Okay.
So the Jones model is based on, this the modified Jones model is based on using adjusted sales instead of sales as the driver for bad debt expense. And that's just change in cash sales as opposed to including credit sales. So we're actually undoing the credit sales. So another way to sort of model conservatism is to look at the accruals as a function of information, economic circumstances directly, right? So instead of looking at write-offs separately, we can just model the bad debt expense directly through the change in circumstances that would cause write-offs to go up. And so we could look at, when sales decline, or when adjusted sales decline, or when receivables decline, what happens to the bad debt, because we expect that to go up. So we already know that on average, there's this kink in accruals for bad news. And although my dissertation showed that for returns, Ball and Shivakumar showed that for operating cash flows, and since then we've shown it works with sales and other signals. So whenever the signals tell you that the firm is doing badly, accruals tend to be much steeper than when the firm is doing well. Okay. The predicted sign here is negative because we've got this expense bad debt, which reduces income, coded as a positive. So the sign is flipped from the standard conservatism regressions. Stephen.
Yeah. Yes, your basic equation there that the bad debt expense is the change in receivable and the write-off, and you're talking about conditional conservatism here. But under your other type of conservatism, you tend to keep your bad debts low. Okay. One of the ideas here is the presumption here is you want your net receivable to be equal to your net cash you're going to receive. Okay. Which is based, of course, on your bad debts. But that cash is still at risk. When anything is still at risk, you need to earn a return to that risk. And so you discount further so that you actually, on average, you get more, you get more than you expected. That, I think, actually explains Shyam's the difference between the estimates and the actual write-offs, that you actually discount because it's still at risk and you need a return to that risk. I don't think you've captured it here. Is that right?
That's right. And that's why this model is useful, because it would capture that effect. So during a recession, or when you're approaching a recession, you would naturally increase your estimate of bad debt expense or increase that allowance percentage. And so that would be picked up in this regression, but would not be picked up if you just directly model the write-offs, right? So there's two things going on. One is that write-offs change, and the other is your estimates for the allowance are changing. And this model allows you to capture both effects. We're going to see that when we add this piecewise linear term, it makes a little bit of a difference over write-offs, but write-offs are the big gorilla.
But are you?
But you're right.
Are you seeing net receivables settling up against cash unbiasedly, or are you seeing them actually settling up always with a bias, okay, which represents that you discount further because the resolution is still at risk.
So you see always that bad debt expense exceeds write-off.
Okay. Okay, so that's what I would call unconditional conservatism. Okay,
Right, we agree on this.
and then when you get new information, you just become a bit more conservative.
Absolutely right.
Which actually, as an aside, makes a point. This distinction between unconditional, conditional, conservative, which they made such a fuss of years ago, I think it's a straw man. It's all the same thing. Okay.
Well, it is and it isn't. So take depreciation, straight line depreciation, right? There you're just basing it on, whatever your purchase price is, whatever your estimated residual value and the number of years, and that doesn't change. So that, whether you use 10 years or 20 years, that makes a difference in your depreciation, but that's fixed, right? So in the bad debt expense, we can change that percentage, but in some other entries, we can't. So I think that there's an area of overlap. I completely agree with you, but I do think that there are cases where it's purely one or purely other. So take goodwill, right? Goodwill doesn't change after you do, except through impairments. Today, there's no amortization. Before 2000, there was amortization. So there was some notion of unconditional. But after 2001, it's impairment or nothing. So that's, I think, in that respect, pure conditional. So I think it's useful to think about differences in accounting methods, which create unconditional conservatism, and sort of the application in the future and changes driven by information. But I agree that there are places where there's overlap. So I mean, I'm not disputing that.
This is not the time to discuss it, but I disagree. If you read straight line depreciation from the book, I understand the problem. Okay,
yeah.
You really set the depreciation so it's a little harsher, so you actually get a higher return for the risk. That's conditional conservatism. When you get new information, that's unconditional conservatism.
Yeah.
When you get new information, you revise your depreciation schedule, and become more conservative. I believe it's all the same thing. But never mind, carry on.
Yeah. So it's the revision that I classify as conditional, and what you do at the initial is unconditional. That's all I'm saying. It's about the timing. Jonathan?
I just didn't follow that completely. I mean, I can understand in a no growth scenario why the net realizable value would be stated lower, or why the book value would be stated lower than the expected collection, to reflect risk. But without growth, I don't see why bad debt expense would consistently be lower than write-offs, right? It would be a sort of level effect, not a constant bad debt expense being more than write-offs, unless you had growth built into the data somehow.
Yeah, so I think Ayung is sort of saying that that period from the Reagan Revolution, middle of the Reagan Revolution through the end of the tech bubble was a period of high growth with just one blip in the Kuwait War, right? So there's consistently high growth throughout that period, and that is likely to have affected how the accounting was done. In addition to using an expected loss model instead of the incurred loss model per se. So once you build those expectations in, and you have constant expectations of growth, that would lead to what we observe. I think that's what's happening. Okay, so let's go through. We sort of take Jackson Liu sample. Jackson Liu hand collected from the financial footnotes the information of bad debt expense and allowances. So they picked the 750 largest firms in 2002 and then collected the information from 1990 to 2010. We've extended the sample by hand collection through 2018. And we exclude some firms, industries, financial institutions, utilities, regulation, and all of that. And we exclude firms with missing composite data. And again, this is consistent with those earlier papers. So we're not trying to do something different. We just want to compare to their previous findings. So as Shyam was saying, the bad debt expense and write-offs are very similar in their distributions, but bad debt expenses on average are a little higher in the mean than write-offs over the sample period. But again, that's driven by the first half. But otherwise, they track each other very consistently, looking at the median, the quartiles, and so on. If you look at the correlations, write-offs and bad debt expense are highly correlated, although there's some evidence of nonlinearity in that the Pearson and Spearman correlations are different. Receivables and bad debt expense are also reasonably correlated. Again, there's a difference between Pearson and Spearman, sort of indicating nonlinearity. And finally, bad debt expense and change in adjusted sales are correlated. And here the two coefficients are very similar, suggesting that it's almost linear. Okay, so if you're going to see V-shaped, it's going to be big in the first two, but not the third one, based on just looking at the correlation evidence. So if we look at the relation between bad debt expense and receivables, the dashed green line is the linear model. Okay, that's the benchmark model there. And if you then just do a lowest, which is sort of, slice the data horizontally, and then take the mean and then connect the means in a smooth line, the red line is what you get. So that's a non-parametric estimate, but it's telling you what's the conditional mean based on those very fine slices of change in receivables. And what you see is that when your receivables decrease, your bad debt expense increases. So the right-hand side of the graph is consistent with the model. As receivables increase, our bad debt expense increases. The left-hand side of the graph is inconsistent with the standard model, right? When bad debt decreases, when receivables decrease, our bad debts increase. And so here the idea is that customers are less likely to buy from you if they're in a recession, if you're in a recession or they're going through hard times. So in that situation, you're going to have more bad debt expense because the customers who aren't buying from you are the ones who are likely to default. The other alternative is that you're collecting more cash. That's why receivables are going down. In that case, you would get the same pattern as you are on the right-hand side. But there's this new factor here that, as your repeat customers don't come back, that's telling you something about the likelihood of collecting. So that's going to drive up your write-offs and then drive up your bad debt expense. The relation between sales and bad debt expense is pretty close to linear, both in the...
Sudipta, if I may interject on the previous slide, is it possible that the credit policy of the firm changes under the conditions that lead to lower sales? I mean, one can make an argument that credit policy might be relaxed to push higher sales in the recession, or it might be tightened to push to avoid incurring bad debt losses under times of stringency. I'm kind of wondering if that may be a much more complex phenomenon going on behind this sunrise type of scattershot plot, and that the model cake or otherwise may not quite capture.
It is certainly something that's possible. I have to agree. I can't dispute that. I'm just trying to think ahead to how I would estimate it. And I think if we looked at the allowance as a percentage of receivables, we could at least detect a little bit of that, whether there's a systematic shift in the ending allowance compared to receivables in those recession periods.
I don't
as
have
opposed to the effect driven by write-off.
I don't have a concrete suggestion, so just
yeah. I mean, I think that that's a good suggestion, and that there are ways that we could try to get at it. Either that, or looking at the coefficient on the bad debt expense as a percentage of sales, and checking whether that actually varies, goes up during recessions, right? But I think, yeah, I have to think a little bit more about how to actually implement it. The tightening of credit policy, maybe change in credit sales relative to cash sales, so the adjusted sales versus regular sales. But I think that is something that we should be able to approach with data. And I think it's a useful thing to think about in terms of developing the paper. So, yeah. I mean, it's different from what Stephen was talking about, the accounting estimates part of it, but certainly related to that. Because this is sort of something that you're changing in the policy that will then affect how you account for. Agnes?
Yes, I'm just kind of wondering that you can also plot, for example, like because the bad debt expense is scaled by the average total asset.
Mm-hmm.
So I wonder if this kind of, curve, how could be, especially it's kind of, interesting to see change of AR, smaller, you actually have larger. But I was just wondering how much would that be potentially driven by the scalar?
So if we do it by scaling by market price, for example, you get same things. I mean, so I have a paper published in the JEE for loan loss in banks.
But if how about you don't do any scalar, just look at per share? Is that possible? Because of the scalar may be related to the decrease of account receivable. If they are related, then what you'll find is actually driven by the change, behavior of the scalar. Anyway, so that's just a question.
I mean, bad debt expense is a very small percentage of total assets. So
yeah,
right. So it's unlikely that it's having a big effect on this. But we can definitely look at other deflators. I don't think that's difficult to do at all. But I don't think that's going to be a major factor. Simply, summary statistics tell us that's 0.3% of total asset. So, and a change in that 0.3% is going to be even smaller. I'm not worried about that, to be honest. When you look at the relationship between bad debt expense and write-offs, you see that there's a very strong linear relation, especially in the bottom left-hand corner. So that's the correlation of 0.93 that we saw earlier in the summary statistics. It's just very, very highly correlated. And the explanation comes from that adjusting journal entry. Okay, so let's look at estimating the balance sheet model. So the simple balance sheet model with just receivables has an adjusted R-squared of just 0.9. When we put in the concurrent write-offs, we get the adjusted R-squared to jump to 59%. So that's providing a lot of information that the change in the receivables, the change in allowance is not doing, right? That's a big kahuna there. If we add in future write-offs as a proxy for expected write-offs, we can get the adjusted R-squared to go up another 6%, 7%. But that's small, and then we have to sort of worry about look-ahead bias and stuff like that. So for the most part, we don't include that thing, but we know that we can increase explanatory power by including the realized write-offs as opposed to some estimate of expected write-offs in future periods. The second part, so column 4, is where we model the asymmetry in the receivable relation. And our prediction there was that the coefficient on the negative dummy would be negative. We see that come through. And we get an increase in explanatory power. So this speaks to your question, Steve, I think. But we don't get anywhere near the size of the bang that we get for the write-offs. So there is an effect, but relative to the write-offs, it's small. At least that's how I'm interpreting this. Okay. So the asymmetry adds a little, but after we model the write-offs, this is now the portion that could be the change in credit policy, the change in accounting, estimation, and all of that. That has a very small impact after we control for the write-offs. Okay. So I agree with you that it is there in the data, and I can try to pin down whether it's changing credit policy or changing the accounting estimates, but it's a very, very small portion of what is going on, okay, in terms of the adjusted aspects. If we do the income statement model does better than the simple balance sheet model, that's the 35%. But once we throw in write-offs and nonlinearity, it's very similar in terms of explanatory power to the balance sheet model. So it's the write-offs that are driving everything. There's also no asymmetry with sales because we saw that the relation was linear. With a modified Jones model, even though it starts supposedly with a balance sheet approach, it doesn't have write-offs, so it does poorly. That's the first column. But as soon as you throw in write-offs, your R-squareds go through the roof, right? So there's a huge omitted variable in the Jones model or the modified Jones model. Agnes.
I think the hand
Agnes,
from
you did.
before.
Okay, Ayung.
Yeah, so Dipta, when I look at the result, I think the model 2, after adding the write-off, it's gonna really catch my attention, right? Given that how much improvement in terms of within partial R-square. So I wonder that if, I don't know whether that's the focus of the study, but like for me, I would be curious to see whether you can interact that WO write-off T with kind of recessionary year versus non-recessionary years, or growth firm, non-growth firm. Just help us to understand the changing ratios of bad debt expense to write-off, like that can capture potentially changing risk premium, changing credit quality, or maybe that's pre 2000 versus post 2000 kind of like accounting standard, SEC's kind of changing policy. Just for me, it would be interesting to see how that relationship changes over time or across firms.
So in the JE paper, we did both of those. So we didn't want to duplicate too much of the analysis from the JE paper for loan loss, but there we looked at both before and after the sort of the SEC enforcement on the expected credit loss model. And we show that things change when the SEC forced the incurred loss model. And we look at recessions versus non-recessions and show you that the asymmetry is much bigger during recessions. So this is just the firm equivalent of loan loss reserves for banks. So we're trying to do things different from that other paper, because otherwise we'll just be told you're just doing the same paper with a different variable. There's no
I was very
incremental
surprised you
contribution.
have not thrown those there. Yeah, thank you.
But yeah, sometimes you have to differentiate your paper to get incremental contribution. Shyam. Shyam, you're muted.
You're muted.
It's an interesting combination of, in the previous slide and the regression, of the stock and flow variables. The dependent variable is a stock variable.
It's a flow variable. It's bad debt
Independent
expense.
variable is a change in sales, and then a couple of stock variables again. So why would
bad debt expense is a flow, Shyam? Bad debt
Flow,
expense is a
yeah.
flow.
Pardon me?
Bad debt expense is a flow variable.
Well, it's true, it is a flow variable, but isn't it proportional to the level of sales?
That's under the income statement method, but under the balance sheet method, it's not. It's sort of, it's the residual from adjusting your allowance to match your receivables. So you're right, under the income statement method, it is proportional to sales, and it's the coefficient is 0.03.
Move on, that's all right. We'll go to your, because this time is going to be up. Thank you.
Yeah.
Can I ask a question on that table? Because of a write-off, is most of those may come from the previous year's sales, and the BDE is this year's sales. So I was just kind of wondering, how persistent is the BDE? Would that if you add the BDE T-1, that will basically persist and then wipe out the WOs, explain the power.
So, I mean, technically the change of receivables is what is creating the change in allowance. So again, as Steve says, you might change your estimation based on whether you're in a recession or not, but that's different from whatever you thought at the time of recording. Right? So whatever you say is why you set up an allowance against that receivable last period. So the only way this would flow through is if there's a change in your estimate of the recoverability.
Sudipta, just to remind you that you have 1 or 2 minutes left, and then of course we can continue afterwards if people are willing to stay.
Yeah, so I just wanted to point out one other thing here. which is that if you look at bad debt expense over time against the modified Jones model, the prediction from the modified Jones model actually goes in the opposite direction to the actual bad debt expense, especially during recessions. Okay, and this is because when sales decrease, the modified Jones model is predicting a decrease in bad debt expense, but in reality, the bad debt expense is shooting up. And so the Jones model does an especially bad job during recessions. This comes back to Sanjay's question earlier. So it's really important to sort of figure out where the flaws are. And here we're showing you that the flaws are especially large during recession. And again, that's because you're not modeling write-offs. So I'm just going to jump ahead a little bit to supply chain finance because this is the new institution. The buyers are guaranteeing essentially to the banks that they will repay. And so now the FASB and ISB have sort of started issuing standards on this, mainly disclosure related because the accounting is simple. The reason for disclosure is that there was a big bankruptcy in 2018 in the UK of a large home builder called Carillon, 8 billion in supply chain financing, that then wiped out the financing institute, the Carillon, which was financing that with SCF of 9.3 billion. And so after that bankruptcy, sort of there's a big scandal. And so now there's sort of push for more disclosure because again, in some sense, this is off balance sheet kind of financing. And so firms are being pushed to disclose more, even though this is a risk for the borrower, not for the supplier. So we do look at trying to get at this. We don't have yet the standards, so we don't have numbers for the US. But if we look at industries which we know have adopted versus those that haven't, we see different patterns in the high SCF industries. We see very smooth lines after 2008, but bumpy lines after the same period for the non-SCF. And if we run a regression, we find that in those industries with SCF, there's after 2008, there's a big decrease. So the 0.023, that asymmetry actually decreases a lot after 2008 in those industries. We drive this down to the firm level by looking at firms that have a big change in their days receivables. And we find that for firms in SCF high SCF industries with big changes in the receivables, which we think are the firms getting the SCF financing, there's a big coefficient there after 2008. So SCF seems to have a really big impact on bad debt expense and reducing this asymmetry, because if you're collecting cash from the bank, you no longer need to set up bad debt expense against receivables. You just have cash on the balance sheet, right? So in conclusion, we show that write-offs and modeling asymmetry increase explanatory power a humongous amount over our standard models. We're talking about 1% versus 60%, 70%, okay? So we have huge measurement error when we try to assess accounting quality. And if we don't fix that, then we're just going to have lots of bad inferences in the literature. So next week, Mia Liang from Wisconsin Whitewater is going to be presenting to us on informativeness of flexibility in cash flow statements, classification standards. Please join us for more fun and games. Thank you all for attending, and thanks for all the feedback.
Thank you. Thank you, Sudipta.